Whenever you have a leaking pipe, you go to the plumber. Whenever your LED light stops working, you go to the electrician. Whenever you want new furniture to be made, you call the carpenter. Well, we live in an era of specialization, and if for such petty things we always call the specialist, then why hesitate calling the experts for one of the most important aspects of our lives? Yes, managing our money. When a lot of people like you and me pool their money into a fund which is professionally managed by experts, it is termed as a mutual fund. For most of us who do not have the time, resources, and the knowledge to pick profitable stocks, mutual funds are our safest bets to generate the returns in the financial markets. Well, there are more than 40 asset management companies in India with over 2500 mutual fund schemes. So mutual funds तो definitely सही है यार, but कौन सा fund तुम्हारे लिए सही है? Well, watch this video ahead, cause that's what exactly we're gonna discuss in this video. 10 things to consider before buying a mutual fund. It is extremely important for you to consider your investment goal because every other goal has a different risk capacity and a time horizon attached with it. So for instance, if you were to invest for an emergency fund to deal with contingencies or unprecedented situations, then definitely you wouldn't want to invest in extremely risky assets such as equities, and might want to invest in safe money market mutual funds such as a liquid fund. On the other hand, if you were to invest, say, for your newborn daughter's college education, then you might have a long investment horizon of 15 to 20 years, and with that long investment horizon your risk taking capacity might also increase, and as a result you might want to invest in risky mutual funds such as an equity mutual fund. But yes, risk is also associated with other factors, and that brings us to point number 2, understanding your risk appetite and your current financial situation. Well, it is famously said that knowing yourself is the most necessary wisdom, and that is extremely important when it comes to making your investment decisions. You should always try to understand what your current financial situation is. Are you employed? Are you unemployed? Do you have enough disposable income to save and make investments? Do you have any dependents such as children, spouses, parents, etc.? Because all these situations would tell you how much risk you're able to take, and based on your ability to take risk, you make investment decisions. So for example, if a person who is in his mid-20s and has enough disposable income to make savings and investments and who does not have a lot of dependents, then for him investing in, say, moderate to high risk equity oriented mutual funds or other mutual funds investing in risky asset classes might sound really good, and however that might not be ideal for a person who is in his late 50s and is planning to retire in a couple of years and also has a family to look after. So well, for him a debt fund or a fund that is of low risk but consistently gives steady returns would be a lot more ideal. But obviously you need to understand that what I was talking about is your ability to take risk and not willingness to take risk. In generally what happens is the ability to take risk does not coincide with a person's willingness to take risk. For example, a highly debt burdened person might want to go to Las Vegas and gamble on his remaining wealth, while at the same time a highly rich and wealthy individual might want to invest in very low return asset classes such as fixed deposits due to his conservative mindset regarding equities. So the bottom line is that you should neither take too little nor too much risk in relation to your risk taking capacity, which is based on your current financial situation. Point number 3, past performance. When you come across an existing mutual fund scheme, you should always look at 3 things: the fund size, fund manager's history, and the fund's returns. Well, the fund size is an indication of the trust and the amount of money that the people have put into the firm, and an indication of the fund size would be its assets under management, or AUM, which is an aggregate value of all of the investments made by all the individuals in that mutual fund. And generally speaking, higher the AUM, safer is the fund, since it is managing more people people's money and more people trust that fund. Furthermore, you should also study your fund manager's history, the person who's responsible for allocating your money, and you should look at whether he has generated successful returns in the past, how many funds does he manage, does he consistently beat the market, and how well has he tackled with the downturns in the market. Do not forget looking at the fund's past returns, the annualized return of a fund, or its compounded annual growth rate, or CAGR as abbreviated. Well, remember that a CAGR of 20% on 100 rupees investment for 3 years would not mean that you are getting a return of 20 rupees every year, but what it would mean is that you are getting a return of 20 rupees on your 100 rupees investment in the first year. Then you're getting a return of 20% on 120 rupees, which is 24 rupees in the second year, and in the last year what you would get is a return of 20% on 144 rupees, which is effectively 28.8 rupees. So this is a lot more than a simple return of 20%, and that is what the power of compounding is. Well, you should also remember that just looking at the absolute CAGR figures is not enough. For example, a CAGR of 15% for a large cap equity fund might not tell us a lot about the fund manager's skills. For example, a return of 15% for a large cap fund when the market itself has returned say 10 to 11% is a good indication of the fund manager's skill. Sensex or Nifty has returned say around 20% would mean that the fund manager has failed at his asset allocation and security selection. Point number 4, the expense ratio. Until now, the returns that we were talking about were gross returns, and what I mean by that is the returns that are generated without excluding the management fees, other expenses, taxes, and all other relevant charges. However, the return that goes to the investor's pocket is the return after deducting all these expenses. And one of the most important expenses is the expense ratio, and the expense ratio is generally expressed as a percentage of the fund's total assets. Mutual fund schemes that are actively managed, in other words, the schemes that require a lot of discretion by the fund manager and the investment teams, and that regularly buy and sell stocks, generally charge a lot higher expense ratio in comparison to a passive or an index fund that generally tracks some benchmark or the market index. With that said, I do not necessarily mean to say that you should not invest in actively managed funds that tend to charge higher expense ratios, but what I definitely want to stress here is that you should always compare a fund's expense ratio with that of similar funds, and compare the fund's returns and risks, and then decide whether or not paying such an expense ratio is rational or justified enough considering its risk and return characteristics. Point number 5, portfolio mapping. I know it's a cliche, but I don't care, I'm still gonna say it. Do not put all your eggs in one basket. Diversification is the only free lunch when it comes to investments. Imagine that you've invested in say 10 large cap equity funds. However, and you might be thinking that since you've invested in 10 mutual funds, your risk is managed quite effectively and that your portfolio is very well diversified. But guess what? If around say top 30 to 40% of the holdings of all your 10 mutual funds are the same, then the diversification benefit that you're getting from investing in those 10 funds is very low. So that is why you should always check at the fund's holdings and see how different they are in order to actually gain those diversification benefits. Point number 6, dividend payout. Well, generally mutual fund schemes offer 3 main options: growth option, dividend payout option, and dividend reinvestment option. You do not receive any dividends, any profits in the form of dividends in the growth option. In case of the dividend reinvestment option, all your dividends are reinvested and you gain more units in the mutual fund, and as a result your holding in the fund increases. And the number 3, the dividend payout option, pays you the fund's profits in the forms of dividend, which are taxed at your current income tax slab rate. And अगर आपको याद हो तो मैंने बोला था that you should always consider your current financial situation and needs when making investment decisions. So do you require regular income? If so, then definitely going for a dividend payout option would be a lot more ideal than going for a growth option or a dividend reinvestment option. However, from a taxation point of view, growth option seems to be the most ideal. Point number 7, tax savings. Benjamin Franklin famously said, "Nothing can be said to be certain in this world except for death and taxes." And yes, both debt and equity funds are subject to taxation. The long-term capital gains on equities is 10%, while the long-term capital gains tax on debt is 20%. However, there are a few mutual funds that offer some tax savings. The so-called equity-linked savings schemes, or the ELSS schemes, are eligible for certain tax savings under the Section 80C of the Income Tax Act of India. However, you should note that under the Section 80C, the maximum eligible amount for tax deduction under an ELSS scheme is 1.5 lakh rupees, and that generally these ELSS schemes have a lock-in period of up to 3 years. Thus, inquire about the nature of your mutual fund every time before you invest. As they say, read all the scheme related documents carefully. Point number 8, the fund manager's investment strategy. Whenever you're planning to invest in a mutual fund, you must always know what strategy the mutual fund manager plans to follow. And as it's said that past performance is but a poor indicator of future returns, what matters more is the fund's investment strategy. You should always do your research in terms of what strategy the fund follows, in the sense which sectors or asset classes does the fund allocate its money to, how often does it rebalance its portfolio, how does it select different stocks and other assets in the portfolio, and whether or not it consistently sticks with its mandated strategy. And definitely doing some research about the fund manager would do no harm to you and would tell you a lot about the fund manager's preferences, biases, and the kind of strategies that he generally follows. An example of an investment strategy is as follows. The fund's purpose is to invest in large cap, publicly listed equities and equity oriented instruments to generate long-term capital appreciation. Point number 9, liquidity and exit load. Well, liquidity is generally not an issue when it comes to almost all mutual funds, and you can redeem your mutual fund units at favorable prices whenever you want to, unlike many asset classes such as real estate. As an investor, you should make sure that you are not investing in funds that charge substantially high exit load, and in general the exit load should be very minimal and close to zero. Point number 10, timing. Just like you wouldn't want to invest in a stock that just went up 50 to 60%, you wouldn't want to invest in a mutual fund that has skyrocketed similarly, right? And at the end of the day, the mutual funds are made up of securities such as stocks and bonds, so market timing is quite critical. Now, one thing that we convey at Valuationary is that if someone says that they can time the market correctly, they're either caught or they're liars. However, one of the best ways to invest in mutual funds is through systematic investment plans, or SIPs. An SIP is a way of making regular installments in a mutual fund, say on a monthly basis, and rather than timing the market, an SIP allows you to invest at the market's highs as well as lows, and as a result your investment price gets averaged out, which in effect reduces your cost of investment and further boosts your returns. Increasing the compounding periods in SIPs as compared to a lump sum investment further generate additional returns for the investor due to the power of compounding. In bull runs like these, people generally tend to undermine the importance of this extremely important financial institution called a mutual fund. And people believe that they are capable enough to manage their own money and also find the best investment opportunities. Alas, good times precede bad times and bad times precede good times. Just like we turn to God only when things go south, we only go to professionals once we've tasted defeat and despair. That is why it is not only important to invest in mutual funds but also to invest in yourself. A small amount of money invested in financial literacy can help you gain abundance of wealth in the long run. We hope this video was immensely beneficial for you, and I'm pretty sure that if you watch this video till the end, then you know that mutual funds तो सही है, लेकिन आपको वो भी पता है कौन से म्यूचुअल फंड्स आपके लिए सही है.